To the Wealth Beyond Debt Show. I'm your host, Billy, and alongside me is Beverly. Today's topic is interest rate versus interest volume and understanding the differences and their impact. In this episode, we will explore two crucial concepts in the financial world: interest rates and interest volume. Understanding these concepts is essential for making informed decisions about your finances. We will delve into the nuances of each, highlighting their differences and demonstrating their impact on various financial scenarios. Let's embark on this journey to financial literacy, empowering you to navigate the complexities of interest and volume with confidence. Welcome, everyone. Today we're diving deep into the whole world of interest, not just the kind found in your bank accounts, but, the intricacies between interest rates and interest volume.
Absolutely. It's a fascinating duality. So we're talking about the cost of borrowing money versus the active engagement in the market, right?
Right, exactly. Let's start with the basics. Interest is essentially the fee you pay to borrow money or the reward you get for saving. It's like if you borrow money from a bank, you're paying extra. And if you deposit your cash, you're earning extra.
It's the classic give and take of finance, isn't it?
And then we have the interest rate, which is really the percentage that determines how much extra you're paying or earning based on the principal. It's like the engine that drives the cost or return of your money.
Yeah, I get that. So basically, if the interest rate is higher, borrowing becomes more expensive and you get better rewards on savings, right?
Exactly, but it's not that simple sometimes, because interest rates are influenced by central bank policies, inflation, and even the overall economic climate. It's like they're constantly adjusting the thermostat of the economy.
Right, and that thermostat can be a bit unpredictable at times.
Indeed. Now, when we chat about interest volume, we're switching gears entirely. Instead of focusing on how much extra you pay or earn, interest volume hones in on the activity in the market, how many contracts or shares are traded over a period. True. It's a measure of market liquidity and participation.
So interest rate tells you the cost structure, while interest volume tells you how lively or active the market is?
Precisely, and it's important because a high trading volume can indicate strong market sentiment, high participation, and often liquidity, but it's in an entirely different conceptual space than a rate that dictates how much you pay or earn on a loan or deposit.
It's almost like comparing apples with oranges, isn't it? One's about cost, the other about engagement.
Exactly. It's like the interest rate gives you the temperature on that cost, yielding a percent, whereas interest volume is more like the crowd measure, how many people are in the room trading.
That analogy really drives home the point. So how do these two concepts sometimes interact in real markets?
Well, take trading volume again. When interest rates shift, they can indirectly affect trading volume. For example, if interest rates go up, borrowing money becomes costlier, meaning there might be less capital available for investments. Hence, trading volume might drop.
Yeah, that makes sense. And the reverse, I suppose, is true. Lower interest rates could boost the amount of money being invested, thus fueling higher trading volumes.
Exactly. But look, it's not always a straightforward link. Economic outlook, market sentiment, and other factors play in too. It's like a symphony with many instruments, and interest rate might be the conductor, but not the only one making the music.
True enough, but sometimes I think the role of interest rate might be overstated. I mean, doesn't market sentiment sometimes drive volume more than just a change in interest rates?
That's a fair point. I agree. It's definitely not a one-to-one relationship. There's a whole layer of market psychology hidden behind those numbers. The article really stresses that we should keep an eye on both rates and volumes to really understand market movements.
And that's a crucial insight for both everyday savers and traders.
Right. Now, shifting gears a little, let's talk about open interest. Enter open interest, the metric that's used mostly in derivatives markets like options and futures. It tells you the total number of outstanding contracts that haven't been settled yet. This is different from volume, which only tracks contracts traded in a period.
So volume is more like the daily activity meter, while open interest is the cumulative score.
Exactly. Think of open interest as the total number of active bets in the market, which gives you a sense of overall engagement, liquidity, and sometimes the conviction behind a trend.
And when both volume and open interest rise, That means there's, strong participation and confidence.
Absolutely. But here's an interesting nuance. If you see volume spike but open interest drops, that might indicate that traders are just um, closing their positions rather than opening new ones. It's like a signal that the trend could be losing steam.
That's quite subtle. And when it comes to calculating open interest, it's not just the sum of, say, daily trades, it's tracking how many contracts are opened versus closed, right?
Right, exactly. If, say, 100 contracts are opened and 50 are closed, then your open interest increases by 50. It's a more dynamic, ongoing measure of market engagement than raw volume.
Makes sense. And now I guess we should delve into the practical side. How do these concepts really affect day-to-day financial decisions, like mortgages and loans?
Yes, indeed.
Attention, a life-changing career opportunity is here, and it can't wait. Agents and brokers are needed in all 50 states, and the best part? No license, no experience required. Every day, Americans struggle with nearly $40 trillion in debt. But you can be the solution. Imagine helping families break free while unlocking the chance to earn $1,000 or more every single day. With our award-winning debt elimination program, you can earn $500 to $1,500 for every person you help. This is your moment to step into financial freedom and change lives. Don't wait. The future is calling. Will you answer?
When you're getting a mortgage, the interest rate plays one of the most critical roles in determining how much you'll pay over time. It's like the heart of the loan calculation. The lower the interest rate, the less you end up paying overall, which can mean tens of thousands saved on a large mortgage.
That is huge. Even a small percentage change can really add up over the loan term, isn't it?
Absolutely. Now, mortgage interest is typically front-loaded, meaning that in the early stages of your payment schedule, a lot more of your payment goes toward interest rather than principal. If you understand that, you can look for ways to strategize your payments or refinance
Right,
for a
that's
better
a really
rate.
practical takeaway. And for investors, grasping the difference between these concepts, like the interplay between interest rate and volume, can really empower their strategies, can it?
Yes. For investors, analyzing volume and open interest trends together can give a much richer picture of market sentiment. Say volume goes up alongside rising open interest, it's often an indicator that new money is flowing into the trend, giving it more sustainability.
Whereas if volume increases but open interest falls, it might indicate that traders are just closing out positions because they no longer see continued momentum.
Exactly, and that's why a holistic understanding is key. We're not just looking at one factor, but the interplay among interest rates, trading volume, and even open interest. It's like piecing together a financial puzzle to
I
better
follow.
predict market behavior.
Now, one thing that puzzles me sometimes is the relation between central bank policies and open interest trends. The article seems to suggest that lower rates can boost trading volume, but how directly does that affect open interest?
That's a great question. While lower interest rates generally increase investor activity by making borrowing cheaper, which can drive higher volume, the link to open interest is a bit more nuanced. Open interest is more about the accumulation or closing of positions, which can be influenced by both the economic environment and individual trading strategies. So, while lower rates might indirectly bolster open interest by encouraging more positions to be opened, other factors like risk appetite or market volatility play roles too.
I see your point, but I wonder if sometimes traders might over-rely on volume indicators without considering the open interest context. That balance is critical, don't you think?
Absolutely, that's a valid critique. Solely relying on volume might lead to misinterpretation of the market's strength. Combining it with open interest gives a fuller, more informed perspective. You really have to see both sides to understand whether a trend is truly strong or on its last legs.
Very true. It's like balancing two halves of a complete financial picture.
Exactly, and if we extend that analogy a bit, it's like having the complete instructions to a puzzle instead of just scattered pieces. Knowing both interest rate and volume details allows, making sound decisions, whether you're planning to borrow money, invest in the market, or even refinance a loan.
Right on. So, what about real-life applications beyond transactions? Say predictive power for market trends. Does the article cover that?
Yes, it does. It outlines that rising or falling open interest, when analyzed with high or low volume, can sometimes indicate market continuation or reversal. For example, rising open interest with high volume often signals strong, sustained trends, while declining open interest with high volume could warn of an upcoming reversal. It's a tool for investors to gauge market momentum, providing, if you will, a kind of early warning system.
That's really compelling. It almost makes me think about how proactive financial literacy really can shape your investment decisions.
Exactly. That's one of the central takeaways, the proactive pursuit of understanding these concepts. The more you know about how interest rates, interest volume, and open interest interact, the better equipped you are to navigate the complexity of financial decisions. Whether saving for a mortgage or trading stocks, this knowledge is power.
It's like having a cheat sheet for the economy. But sometimes, do you think it's too complex for the everyday person?
I'd say complexity is relative. Sure, at first glance, it might seem overwhelming, but breaking it down like we did shows that each of these metrics has a clear role. And once you understand them, they become practical tools rather than abstract numbers.
That's a solid point. Exactly. It's about empowering yourself with knowledge. So if someone wanted to start applying these insights immediately, what would you suggest?
First, I'd recommend getting comfortable with the basics. Take a look at your mortgage rates, understand how your savings grow over time with interest, and then, as you dabble in trading, start watching volume and open interest trends. Use these metrics to inform your decisions on when to buy, when to sell, or even when to hold. It's all about synthesizing data into actionable insights.
And maybe comparing different financial products based on these factors can also help make smarter choices, right?
Absolutely right. Being informed helps you negotiate better terms on loans and choose investment avenues that align with your financial goals. And staying updated with central bank announcements and economic outlooks can provide additional clues on where the market might head
It
next.
really ties everything together. Well, this exchange has been seriously enlightening. The interplay between interest rate and interest volume is more than just academic. It's practical and very real in our everyday financial lives.
Couldn't have said it better myself. The nuanced understanding of these concepts is what can differentiate well-informed decisions from the rest. It's all about turning financial theory into practical empowerment.
Here's to making smarter, more informed financial choices. Thanks for the deep dive into this rather intricate topic.
Thank you as well. And remember, folks, whether it's managing a mortgage, investing in markets, or simply saving wisely, knowledge is your best tool.
Absolutely. Stay curious and keep exploring. Till next time.
Hi, I'm Sarah. Overwhelmed by debt? There's a proven way out. Debt-free, made easy, transforms debt into money back in your pocket. Eliminate all debt fast, without refinancing or consolidation. Proven results since 2004, over $2.8 billion eliminated. Thousands have eliminated mortgages, credit cards, auto, student, and personal loans. No refi, no consolidation, just results. Our Debt Crushers AI software eliminates all debt. Fast, simple, 100% satisfaction guaranteed. I have eliminated $275,000 of my own debt. Scan or click on the link below to start putting your money back into your pocket. Eliminating debt since 2004.
Thanks so much, Billy, for guiding us through another wonderful show. And to our amazing listeners, thank you for tuning in to the Wealth Beyond Debt show. If you found today's conversation valuable, please hit like, share this episode, and help more people maintain their mental health. We'd also love to hear from you. Drop a comment with topics you'd like us to cover next. We're all in this together, fighting against the big banks and putting your money back in your pockets. Let's summarize this all. Understanding the distinction between interest rate and interest volume is crucial for making informed financial decisions. The interest rate represents the cost of borrowing or the return on investment, while interest volume refers to the total amount of interest paid or earned over a specific period. By analyzing both concepts, individuals and businesses can better navigate their financial landscape, optimize their investments, and manage their debts effectively. Ultimately, a comprehensive grasp of these terms will empower stakeholders to achieve their financial goals more efficiently. This was a quick overview. To get the full details, read our blog on our website. Link is in the description box.